All right, let's jump into this deep dive. You sent over some really cool research on using deep learning to predict, what do they call it? Factor premiums in the stock market.
Yep, factor premiums.
Basically, it's trying to see if these complex algorithms can actually help us make smarter investment choices.
I think a good place to start would be to kind of unpack this idea of a factor premium.
Yeah, let's break that down.
Think of it like a potential extra return you could get by tilting your portfolio towards certain types of companies. Like, for example, if you believe small companies are going to outperform the market, you might invest more in them. That's like a factor bet.
So it's like instead of just buying like a broad market index fund, you're trying to be more strategic with how you invest.
Exactly. And this research you sent over, it takes this concept a step further with something called factor timing. It's not just about picking the right factors, but also trying to predict when those factors are more likely to do well and adjusting your investments based on that.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoyed this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so it's like trying to time the market, but instead of guessing when the whole market will go up or down, you're focusing on specific types of companies.
Precisely. The research digs specifically into a factor called conservative minus aggressive, or CMA.
CMA, okay.
Yeah, so imagine you're looking at two groups of companies. The conservative ones, think of them like steady tortoises. They're financially stable, reliable, And then you have the aggressive companies. These are more like hares chasing that risky growth, but also potentially more volatile.
So the CMA factor is basically like betting on the tortoises to outperform the hares.
You got it. Now, the big question here is, can we actually use these fancy algorithms to predict when those tortoises are going to have their moment?
Right. That's where the deep learning comes in, I guess.
Yeah.
What kind of economic indicators are they looking at to forecast the CMA factor?
So they're looking at two main things: the term spread and the default spread. Term spread basically tells us the difference between short-term and long-term interest rates, which kind of gives us a glimpse into future economic expectations.
So if long-term rates are way higher than short-term rates, that could be a signal the economy is expected to grow.
Right. And the default spread, well, that measures how risky corporate bonds are, which gives us a sense of how healthy the credit market is.
Interesting. So they're trying to connect these big picture economic signals with how different types of companies might perform. How did the researchers actually test these deep learning models?
They used a whole bunch of different predictive models, starting from simpler ones like linear regressions, and then going to more complex ones like neural networks and random forests. And here's the really cool part. They used something called out-of-sample R-squared to see how well these models could predict the future.
Out of sample. Okay.
It's like giving the model a pop quiz on data it's never seen before.
So it's not just about explaining what already happened. It's about whether they can actually predict future market movements.
Yeah, exactly.
Did they find any models that could actually do that?
They did. And what's exciting is that some of the more flexible models, particularly a neural network they called NN3, it showed real promise in explaining those ups and downs of that CMA factor premium. But, with anything in the market, there's usually a catch.
Yeah, there's always a catch, right? Like, while this NN3 model did show some really impressive potential, it also, it showed some signs of being a bit unstable.
Oh, really? Unstable how?
Well, I mean, financial markets, they're incredibly complex. They're always changing. A model that looks amazing one day might not be so great the next.
It sounds a bit like trying to catch lightning in a bottle. You might see its power, but actually harnessing it consistently, that's the tricky part.
That's a great analogy. And this is where the whole idea of transaction costs really comes into play. Like, if a model is always changing its predictions, that could lead to a lot of buying and selling, a lot of trading. And all those trades, they can really start to eat into your profits. So even if you have a model that can predict the market somewhat accurately, you could still end up losing money if you're not careful about how often you're trading.
Exactly. That's a key point. And the researchers, they actually looked into this. They investigated what the optimal trading frequency would be for each model, trying to figure out, like, how often should you actually rebalance your portfolio based on what the model is saying, to get the best returns without getting killed by those transaction fees.
Yeah, makes sense. It's like finding that sweet spot between like acting on the model's insight and not going overboard with the trading.
Right.
Did they find like a magic number for how often to trade?
Well, not really a magic number. I mean, it's not one size fits all, but they did find that adjusting the trading frequency based on, historical data, that could actually significantly improve the returns, especially for those more complex models like NN3.
So it's not just about what the model predicts, but also about being strategic with when you actually make the trades.
Exactly. It highlights how important that execution is, for any kind of factor timing strategy.
Okay, so NN3, it's powerful, but maybe a little bit finicky. Were there any other models that stood out, like in terms of both performance and, how practical they are to use?
What's interesting is that the random forest model, that one actually emerged as a pretty strong contender.
Okay.
It gave some really solid performance, but with less volatility than NN3, so, potentially leading to lower trading costs.
So maybe slow and steady wins the race in this case. It's like how, like, sometimes those less flashy approaches can be surprisingly effective.
Absolutely. And even a simpler model, something like a basic OLS regression, but with a few little tweaks, even that could do better than just, holding a constant mix of assets like a basic benchmark.
It's a good reminder that you don't always need the most complex tools to get an edge, Sometimes it's more about careful analysis and making smart decisions about timing.
Yeah, for sure. The key is really understanding those trade-offs, between how complex the model is and things like transaction costs, those practical considerations.
This has been a really incredible deep dive. We've looked at how these different models work, how they perform, and even, this whole thing about finding the right trading frequency. But I bet you're wondering, like, what does this all mean for your own investing?
Yeah, that's the million-dollar question. And it's, important to remember that this research is more like a glimpse into what might be possible, not a guaranteed path to, to striking it rich.
Right.
AI and deep learning, they're powerful tools, but they don't replace, like, human judgment and, understanding your own financial goals and how much risk you're comfortable with.
So it's not as simple as just like plugging into an algorithm and letting it make all your choices for you.
No, definitely not. It's more like thinking of these tools as really sophisticated assistants. They can help you crunch the numbers, see potential opportunities, maybe even help personalize your portfolio.
That's a good way to think about it. Using these advancements to help make better decisions, not just giving up control. But with all this talk about AI, it's easy to get caught up in the hype. What are some things to keep in mind as we navigate this whole, world of AI-driven investing?
First thing, I think, is to approach any AI-driven investment strategy with a healthy dose of skepticism. Remember, no model is perfect, and markets, well, they're inherently unpredictable.
So don't put all your eggs in one basket. Diversification and, managing your risk, having a long-term perspective, those are still really important.
Absolutely. And it's also crucial to remember these models are only as good as the data they learn from. If the data is biased or incomplete, the model's predictions, well, they're going to be flawed.
That makes sense. So we got to be critical thinkers, ask questions about how these models are built and what data they're actually using.
Exactly. As we move further into this world of AI-driven investing, it's so important to stay informed, understand the limitations, and, continue learning and adapting.
Well, this has been a really insightful deep dive. We've explored a lot, from trying to predict the market, the potential of deep learning, to even those practical things like figuring out the right trading frequency.
Yeah, we've only just scratched the surface, but hopefully this is giving you a better understanding of this whole field, it's really exciting and it's changing so fast.
Awesome. Well, a huge thank you for joining us on this deep dive. And remember, the more we all understand about, what's happening in the financial world, the better decisions we can make.
Keep exploring, keep learning, and keep diving deep.
Until next time.